Hi. Well, we are moving on along down the balance sheet, and we are up to class 27A. So if you're Monday, Wednesday, Friday class 27, first video. If you're Tuesday, Thursday class, it's class 20, first video, so 20A. Alright, so we are up to plant assets, natural resources, and intangibles. So I'm gonna talk about the important stuff, the things that make the money for the company, big ticket items. Alright, so how does a business measure the cost of a plant asset? So as you'll remember, we have our current assets and our plant assets. So we're on to plant assets. Plant assets are long-lived, tangible assets used in the operation of the business. These assets include land, buildings, equipment, furniture, fixtures, and automobiles. Often plant assets are referred to as property, plant, and equipment. So you'll see that sometimes on other companies' balance sheets. You'll see instead of what we call plant assets, they just call PP&E, property, plant, and equipment, or fixed assets. So fixed assets, kind of like the name implies, it's like in the place, fixed assets. So you can see different names for these kinds of assets. We're going to call them plant assets. So how does a business measure the cost of a plant asset? We talked about this a little bit way back when we first learned about assets and that distinction between current assets and plant assets, but it's always good to remind ourselves. Plant assets are different from other assets, such as office supplies, because plant assets are long-term, lasting several years. This requires businesses to allocate, A-L-L-O-C-A-T-E, allocate the cost of the asset over the years that the asset is expected to be used. This allocation of a plant's assets cost over its useful life is called depreciation and follows the matching principle. Depreciation is the process by which businesses spread the allocation of a plant's cost over its useful life. The matching principle ensures that all expenses are matched against the revenues of the period. Because plant assets are used over several years, a business will record a portion of the cost of the asset as an expense in each of those years. All plant assets except land are depreciated. We record no depreciation for land because it does not have a definitive or clearly estimable life. So it is difficult to allocate the cost of land. So, plant assets, they're long-lived. We're going to depreciate them. So I know you remember our accumulated depreciation and our depreciation expense. So that's what we're doing to plant assets. So if it's a plant asset except land, we depreciate it because they get used up. Alright, so how does a business measure the cost of a plant asset? Alright, so like plant assets, you don't really just go to the store and buy them. Well, some of them you do, but a lot of them for companies will involve some amount of building or customizing. So what's the actual cost? On Exhibit 9.1 on page 475, it summarizes the life cycle of a plant asset in a business. The business begins by acquiring the asset and recording the asset on its books. This involves determining the asset cost that is reported on the balance sheet. As the business uses the asset, it must record depreciation expense. In addition, the business also incurs additional expenses such as repairs and maintenance related to the asset. Finally, When the asset has reached the end of its useful life, the business disposes of the asset. Each of these stages in the life of a plant asset must be recorded on the business's books. So you can imagine you acquire it, that has a certain cost, and you add that all up and put it on the books as your cost of the asset. Then, as you use it, you have to depreciate it, right? And maybe you do some maintenance, maybe you do some repairs, maybe some upgrades. And then when you're done with it, you dispose of it. And all this requires accounting entries because you're spending some money. So there's going to be accounting entries at all different stages of using an asset. Let's go to land and improvements. Oh, I'm sorry, I skipped this. Great, there you go. How does a business measure the cost? Okay, so let's talk about the cost first, right? Because you got to acquire it. Plant assets are recorded at historical cost, right? So when you put it on the books, it's what you spent for it, and that cost doesn't go up and down over the life of the asset. Even though we know in real life the cost of things go up and down. Real estate values change, so yes, they go up and down, but we just put it on the books at historical cost and leave it there. The amount paid for the asset is the historical cost. This follows the cost principle, which states that acquired assets and services should be recorded at their actual cost. The actual cost of a plant asset is its purchase price plus taxes, purchase commissions, all other amounts paid to ready the asset for its intended use. So you get to add up everything that goes into that asset and getting it ready. So if you're building a building, everything it costs to build that building, the architecture plans, of course the cost of building it, inspections, everything is part of the historical cost of that building. So anything that gets it ready to use the way you want to use it. So you might buy a van for delivery and it costs $20,000 to buy the van, but you customize it because you're a food delivery service, so you put in some heating elements and some refrigerating elements, and it costs another $10,000 to customize it. Well, that's a $30,000 cost, right? You add everything up to get it ready. Let's talk about land and improvements. The cost of land includes the purchase price, brokerage commissions, survey and legal fees, delinquent property taxes, title transfer fees, the cost of clearing the land, and the cost of removing old buildings from the land. Land is a unique kind of plant asset that is never depreciated. So all those other things you buy, they get depreciation, but not land. So everything you use to get your land ready, to get it ready to build on, that is part of the cost of the land. The building stuff is separate, but the land, getting it ready, you get to write that off. All right. Land and land improvements. All right. The cost of land does not include fencing, paving, sprinkler systems, lighting, signs, and other improvements to the land, such as landscaping. Those costs are collectively referred to as land improvements. A land improvement is depreciable improvement to the land. These costs are separately identified from the land itself, and they are depreciated. So, to go back to the last screen, the cost of the land is what it costs to get it ready to start building on. So, you pay for it, you pay sales commissions, you might have to push some dirt around, remove an old building. That's all getting the land ready. But once you start building on it, making improvements, those are separate and those get depreciated, right? Because the fence will wear out. So that's an improvement. So that's going to be separate from the land. So let's give an example here. Smart Touch Learning purchases land on August 1st, 2015 for $50,000 with a note payable. Other costs related to this transaction include $4,000 in delinquent property taxes, $2,000 in transfer taxes, $5,000 to remove an old building, and a $1,000 survey fee. The additional costs are paid in cash. So, this is our example. So, what is the actual cost of the land? Alright. As you can see from the computation in Exhibit 9.2 on page 476, the cost of the land not only includes the acquisition cost of $50,000, but the property taxes to bring the taxes current. You know, you can't transfer a title of land without the taxes being current. The county just won't record the transfer. So you got to pay the taxes, and that's part of the transfer. Transfer taxes, removal of building, survey fees. That's all getting it ready. You usually survey it when you buy it to make sure of your boundaries. So that's all stuff to get it ready. So this all gets added to the cost. So the actual cost of the land is $62,000. So that's what we're going to put it on the books as. So as you can see, as you recall, we did the note payable for $50,000. All those other little items, like the taxes and the survey, we paid cash for. So land, the asset land, increases with a debit, $62,000. That's why we had to calculate the cost, because we got to put it on the books. This is putting it on the books right here. All right, so land, $62,000. Notes payable, the liability increased, so that's the credit. And cash, the asset cash, we paid out. So we paid out $12,000, and that, of course, totals $62,000, so our debits equal our credits. The journal entry to record the acquisition of the land would include a debit to land for $62,000 and credits to notes payable for $50,000 and to cash for $12,000. So, to summarize, the cost of land includes the following paid by the purchaser: purchase price, brokerage commission, survey and legal fees, delinquent property taxes, taxes assessed to transfer the ownership title on the land, cost of clearing the land, and removing unwanted buildings. Cost of the land doesn't include fencing, paving, sprinkler systems, lighting, signs. These separate plant assets are called land improvements. A land improvement is a depreciable improvement to land. Unlike land improvements are subject to depreciation. So once you get that land ready, start adding to it, those are called improvements. A fence, a sidewalk, anything you add, the building, of course, all improvements, and you can depreciate those. The land, not going to depreciate it. So you add up your costs for the land, put the land on the book separate, then you start doing improvements. Okay, let's talk about buildings. A company can acquire a building one of two ways. It can have it constructed, or by purchasing a finished building. When a building is constructed, the cost of the building includes architectural fees, building permits, contractor charges, and payments for materials, labor, and miscellaneous costs. So, building is going to be constructed, and you're going to put a building on the books too. So you'll need all its costs, right? So you buy the land, gather all its costs together. Buy or build a building, gather all its costs together. When a building is purchased, when a building is acquired, the costs include the purchase price, any brokerage fees, any delinquent taxes, any renovation costs necessary to prepare the building for use. So just like when you purchase land, if you purchase a building, whatever you put in it to get ready, that's the cost of that building. What else might you buy that's a plant asset? Well, you might buy machinery and equipment. The cost of machinery and equipment includes the purchase price, transportation charges, insurance while in transit, sales tax and other taxes, purchase commission, installation and testing costs. After the asset is up and running, the company no longer capitalizes the cost of insurance, taxes, and ordinary repairs and maintenance to the equipment account. From that point on, insurance, taxes, repairs, and maintenance costs are recorded as expenses. So anytime you buy or build a machine, everything it takes to get it up and running, that becomes part of the cost of the machine. That's what you're going to depreciate. Now you're going to do some of those same things, right, after you get it up and running, but once you get it going, that equipment, that just becomes an expense, right? So imagine you're getting a bulldozer, and so you have to put it all together. It costs you some money. You have to put tires and treads and all kinds of things on it. Every once in a while you're going to replace some of that stuff. That becomes repairs or it becomes maintenance, and we'll talk about that in a little bit, but the cost of the bulldozer, the amount you depreciate, is everything to get it ready. Furniture and fixtures. Furniture and fixtures include desks, chairs, file cabinets, display racks, shelvings, and so forth. The cost of furniture and fixtures includes the basic cost of each asset, less any discounts, plus all other costs to ready the asset for its intended use. For example, for a desk, this may include the cost to ship the desk to the business and the cost paid to a laborer to assemble the desk. So that's pretty easy to imagine. Whatever it costs to get it ready to use, just like get the land ready to use, get the building ready to use, get the equipment ready to use, well, furniture too. Whatever it costs to get it ready to use, that's your cost. That's what you're going to depreciate. After that, yeah, you may do some money, but a lot of that's something else. So once it's ready, that's what you put on the books. That's what you're going to depreciate. It's easy to imagine a lump sum purchase, especially with furniture, fixtures, or you buy parts of a business that's going out of business. Oh yeah, we'll take your desk, we'll take your computers, we'll take your shelving, and we'll take some of your delivery trucks, right? And we'll give you $50,000 for it, right? It's easy to imagine one big lump of a purchase of several different things. A company may pay a single price for several assets as a group. This is called a lump sum purchase. For example, SmartTouch Learning may pay a single price for land and building. For accounting purposes, the company must identify the cost of each asset purchased. The total cost paid, 100%, is divided among the assets according to their relative market values. The relative market value method is a method of allocating the total cost, 100%, of multiple assets purchased at one time. Total cost is divided among the assets according to their relative market value. So you say pay $50,000, and then you figure out the market value of everything. And then you can just say, okay, well, if I purchased a car and a truck and a lathe. Let's say I'm buying some machinery from a machining company, and I buy a car, a truck, and a lathe, and I just said, I'll pay you, $100 for all that. Let's keep it simple, $100 for all that. So I go and I find out that out of that $100, 10% is the car, 80% is the lathe, and 10% is the truck. So I'll just assign the values that way. Okay? That's all that means. But you have to put them on separately because you're going to depreciate them separately. They're going to have different lifespans. So you got to depreciate each of those things separately. So you got to figure out a cost for each. And we just base that on what percent of the purchase was that one thing. So here's an example. Suppose SmartTouch Learning paid a combined purchase price of $100,000 on August 1, 2017 for land and building. So you buy land and building together, of course, right? That happens all the time. And usually they don't separate that out. They say, we'll sell you this house for $100,000. Now, if you're a business, you got to put it on the books and you got to separate it because you don't depreciate land, but you do depreciate the building. So, an appraisal indicates the land's market value is $30,000 and the building's market value is $90,000. So they got a good deal. They only paid $100,000 for these two things, but they're worth $30,000 and $90,000. How will the accountant allocate the $100,000 for both assets? Well, first you calculate the ratio of each asset's market value to the total for both assets. So you add the 30 and the 90. You say the market value is 30, the market value is 90. That means it's $120,000. They only paid $100,000, but the market value is $120,000. And of that $120,000, 30 is the land, 90 is the building. So the total appraised value is $120,000. The land represents 25%. The building represents 75%. So you take those ratios, right? So you figure that out. You go 30 divided by 120 is 25%. 90,000 divided by 120 is 75%. And I take those and I apply that to the purchase, which was $100,000. So let's look at that. So for Smart Touch, right, they assigned $25,000 and $75,000 to each asset, right? Once I figured out my ratio, right, I said, well, here's the market value. The land is 25% of the market value, so I'll make land 25% of what I paid. So if you paid $100,000, that means the land is worth, it goes on the books, right? It's worth 30. We've already said that's the market value, it's worth 30. But we didn't pay that. We were only putting what it cost. So it cost us 25 and the building cost us 75. So we're allocating that based on its market value, but we're only putting on the books what we paid for it, right? So we have to figure that out, use the market value, find the ratios, and apply those same ratios to what we paid. So here's what that would look like, right? So the journal entry will include a debit of $25,000 to land, a debit of $75,000 to building, and a credit of $100,000 to notes payable. So here's that, because we know we're only paid $100,000. We borrowed the money to do it, so we know we've got a note payable of $100,000. We apply our ratio 25/75 to the $100,000, and we end up with land on the books for $25,000 and the building on the books for $75,000. So when we go to depreciate that building, we're depreciating it based on $75,000. So you may have noticed a couple times in these slides so far this chapter, this term capitalize has been used. So accountants, when money gets spent, you divide it up into either capital or revenue expenditures. All right. So when you're buying this property, plant, and equipment, right, the land, the building, we call those capital assets. So there's a capital expenditure. Revenue expenditures are basically expenses. It's something we're spending in this period to make revenues. So you have to decide whether you're going to categorize. Anytime money leaves, anytime as an accountant, anytime you pay out money, you have to decide, is this a capital expenditure or is this a revenue expenditure? If it's a capital expenditure, you need to book it as an asset. If it's a revenue expenditure, you need to book it as an expense. Accountants divide spending on plant assets after the acquisition into two categories, a capital expenditure and revenue expenditures. A capital expenditure is an expenditure that increases the capacity or efficiency of a plant asset or extends its useful life. So you're going to add that to your asset. A capital expenditure adds to the asset. A capital expenditure is also called a balance sheet expenditure because the cost of the expenditure is reported on the balance sheet as an asset. A capital expenditure is debited to an asset account because it increases the asset's capacity or efficiency or extends the asset's useful life. Examples of capital expenditures include the purchase price plus all other costs to bring the asset to an extended use. Also, an extraordinary repair is a capital expenditure because it extends the asset's capacity or useful life. Now, an expense occur, right? So just an expense or revenue expenditure. Expenses incurred to maintain an asset in working order, such as repair or maintenance expense, are not debited to an asset account. Examples include the cost of maintaining equipment on a truck, such as changing the oil filter and replacing its tires. These ordinary repairs are called revenue expenditures and are debited to repairs and maintenance expense. Revenue expenditures are often called income statement expenditures. Do not increase the capacity or efficiency of an asset or extend its useful life, and are reported on the income statement as an expense in the period incurred. So capital expenditures create or add to an asset. Revenue expenditures, or just expenses, repair or maintain an asset. So think about a delivery van, right? So you've got this delivery van and you purchase it, and you pay tax on it, and you add a refrigerator unit and you make it a little better than it was, and all those costs are capitalized. They create that cost of that asset. It goes on the balance sheet as an asset. Now as time goes by, you have to change the oil, you have to change the tires. Well, that's just normal expenditures. So those are expenses, and we put those on the books as an expense. Let's suppose you decide to fix it up a little bit fancier and make it better. You put in a turbocharged engine, and it's got a new engine. Now it's going to last a much longer. It's going to perform better. So that's a capital expenditure. So the amount you spend on that engine gets added to the asset. All right. So it's pretty much, just something you would ordinarily spend to keep something running, just an expense. Something major and big that increases its life or makes it better, capitalized, becomes part of the asset. So here's some other examples. Exhibit 9.3 on page 480 shows some A, capital expenditures, and B, revenue expenditures for a delivery truck. Treating a capital expenditure as an expense, or vice versa, creates an accounting error.